If you are interested in finance and investment, you have probably likely heard of Warren Buffett by this point. However, for those who do not know who Warren Buffett is, he is currently referred to as the GOAT of stock market investing because of his skill of consistently outperforming market returns. Theoretically, if he had invested $1,000 in his business when it first began, you would have earned more than $30 million by now. And in 2022, he outperformed the market once more by 22%, gaining 3% as the market fell 19.44%. What guidelines has Warren Buffett followed to this day in order to be so successful? Let's begin by looking at the first one. Rule number 1, don't lose money, and rule number 2, don't forget about rule number 1.
Rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are.
Okay, I'm just kidding, but this is actually one of the things which he said in an interview in the past, and it is certainly an important mindset that all investors should have. Okay, so here are the actual rules which you should follow. Rule number 1. Never invest in businesses you don't understand. He has repeated this guideline to several people throughout the years.
I should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now.
You need to have a thorough understanding of how a company will likely function economically in the future in order to invest in it. For instance, if you want to invest in a chewing gum company, you need to be aware of how the industry will likely change over the next 10 to 20 years, as well as the competitors. Because of this guideline, Warren Buffett avoided investing in tech businesses because he was unsure of which company would succeed in the long run. But that does not mean he enjoys utilizing the goods and services provided by such businesses. It just means he does not comprehend the industry well enough to make an investment. So, don't just buy Tesla shares because it's cheap if you don't understand the business. Rule number 2. Look at the intrinsic value of a company and avoid emotions. Instead of letting their emotions or biases affect their investing decisions, Warren Buffett advises investors to try to objectively evaluate the worth of a firm, as opposed to market value, which is the price at which a firm is currently trading on the stock market. Intrinsic value refers to a company's genuine or inherent value. Investors can take into account a number of elements to determine a company's intrinsic worth, including its financial accounts, competitive edge, management group, and possibilities for future expansion. Buffett thinks that investors can make more intelligent and sensible investment decisions by focusing on a company's intrinsic value rather than the market's perception of it. Buffett often cautions investors against acting on their emotions because they can result in irrational choices. For instance, if an investor develops excessive optimism or pessimism about a firm, they may be more inclined to act impulsively and without carefully considering the company's fundamentals. Buffett is of the opinion that investors can make more rational and successful investment decisions by putting aside feelings and concentrating on a company's fundamental value. Rule number 3. Don't miss out on big opportunities.
Big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it.
What Warren Buffett means by this rule is sometimes you just have to take the risk and take full advantage of the opportunity if there is a firm that you understand and that you believe is undervalued. However, you must remember rule number 1 and not just buy GameStop or AMC because it seems undervalued. Regardless of the type of company you intend to purchase, you must comprehend the industry. Warren Buffett previously made similar error, which cost him billions of dollars. Rule number 4. Be fearful when others are greedy, and be greedy when others are fearful.
When it goes down, it's bad. We think just the opposite. When it goes down, we love it because we'll buy more, and if it goes up, it kills us to buy more.
Buffett's advice to be frightened when others are greedy stems from his understanding of market psychology. When markets are going well, investors may grow confident and keep buying assets, driving up prices and causing asset bubbles to rise. These bubbles eventually burst though, and individuals who bought during the bubble suffered huge losses. Therefore, it is crucial for investors to be conscious of these emotional biases and make their investing decisions on extensive research rather than allowing their feelings to rule them. This likewise holds true for the reverse circumstance. Many assets may become undervalued when people are worried and the market is falling. Consequently, it is crucial to be greedy when others are fearful. Rule number 5. Invest in yourself.
Investing in yourself is the best thing you can do. Anything that improves your own talents. Like, nobody can take it away from you. They can run up huge deficits and the dollar can become worth far less. You can have all kinds of things happen. But if you've got talent yourself and you've maximized your talent, you've got a terrific asset.
This is a fairly easy rule, but it can be challenging if you procrastinate like I do. As he stated in an interview, no one can take away your talent and value, not even inflation and taxes. You should always be working to improve your knowledge and skills. Never stop learning new things you find interesting, such as watching my YouTube videos, reading, or even listening to podcasts might all work. However, never put a stop to your desire to learn new things. So, Warren Buffett has a couple of more important things that you can watch from the video that is popping up on your screen. His financial advice has changed the lives of many people. Make sure to watch them too. Till then, goodbye.